Earnings season is here, and it's rewriting the narrative. For weeks, Wall Street bears have warned that tariffs, stubborn inflation, and the Fed's hawkish stance would choke growth. Add in the public tug-of-war between the U.S. administration and Fed Chair Jerome Powell, and you'd expect chaos in the markets. Some even claim the AI boom had peaked. But the first wave of earnings? It's defying the skeptics. Big names across tech and infrastructure are posting results that show AI demand isn't cooling. It's accelerating. As one top analyst put it, this is not a bubble bursting, it's a build-out that's just getting started. That outlook matters, because in a macro environment where rates remain high and tariffs loom, corporate strength becomes the ultimate hedge against uncertainty. These companies aren't just surviving, they're thriving in conditions that were supposed to crush them. Yet, here's the twist. Despite blockbuster reports, a few stocks didn't soar. In fact, some even plunged. Why? Analysts are calling it fear selling, a knee-jerk reaction to headlines on inflation and policy instead of fundamentals. And history has shown what Warren Buffett once said, be fearful when others are greedy, and greedy when others are fearful. In other words, volatility often hands smart investors their best opportunities. So in this video, we're breaking down 3 stocks that just reported strong earnings but were dragged down by macro-driven selling. These aren't broken stories. They're leaders with real growth drivers, now trading at levels that could be gift-wrapped for long-term investors. If you've been waiting for your next buy-the-dip moment, this might be it. First on the list is Taiwan Semiconductor Manufacturing Company Limited, ticker symbol TSM, the undisputed heavyweight behind the world's most advanced chips. While much of the spotlight has been on NVIDIA and AI model developers, none of their breakthroughs happen without the ultra-precise foundry capabilities TSMC delivers. And despite macro headwinds, this earnings season proves that TSMC isn't just holding up, it's powering ahead. TSMC just reported Q2 2025 results that blew past expectations. Revenue jumped 44.4% year-over-year, and profitability soared, thanks to robust demand for cutting-edge 3nm chips and pricing strength across the board. High-performance computing now leads its revenue mix, underscoring the company's growing role in powering AI data centers globally. Even more impressive, operating margins surged past 49%, and EPS shot up nearly 67%. This isn't just financial strength, it's operational excellence in one of the most complex industries on Earth. What's really compelling is the 3nm ramp. While 5nm remains a solid contributor, 3nm has taken off faster than expected. As older nodes like 7nm phase out, TSMC's shift to bleeding-edge fabrication is clearly working, and its relevance to AI and high-performance platforms is only increasing. In fact, data center demand helped accelerate quarter-over-quarter growth in the HPC segment, while no major segment showed contraction. Yet, the stock didn't rally after earnings. Why? Forward guidance was softer, with management projecting a modest slowdown in revenue growth and margin compression in Q3, but analysts see this as a short-term reset, not a structural problem. As CFO Wendell Huang noted, TSMC still expects strong demand for leading-edge nodes going forward. In today's environment clouded by tariff concerns, inflation pressure, and a hawkish Fed, fear selling is real. But as Warren Buffett famously said, opportunities often emerge when others are uncertain. TSMC's fundamentals are intact, its leadership in chip making is unchallenged, and its role in the AI economy is only expanding. This earnings pullback could be a golden entry point into one of the most strategically vital companies of the decade. Next is ASML holding NV, ticker symbol ASML, arguably the most critical company in the entire global semiconductor ecosystem. If you've never heard of ASML, you're not alone. Most retail investors can't explain what EUV lithography is, but without ASML's machines, there is no NVIDIA, no Apple Silicon, no AI boom. ASML is the only company in the world capable of producing extreme ultraviolet lithography systems, which are essential for producing the most advanced chips used in AI, high-performance computing, and smartphones. And in the second quarter of 2025, they reminded Wall Street exactly why they're irreplaceable. ASML just reported a strong quarter with 7.7 billion euros in net sales and gross margins of 53.7%, both exceeding their own guidance. That alone is impressive, but what stood out even more was the company's steady discipline. Management continues to follow a pattern of under-promising and over-delivering, which long-term investors have come to appreciate. Despite cautious language about 2026 due to macro and geopolitical headwinds, ASML reaffirmed its long-term 2030 targets, and their track record shows they tend to hit or exceed their goals. What's more, ASML ramped up its stock buyback activity, snapping up over 1.4 billion euros worth of shares in Q2 alone, and they did it smartly, buying more aggressively when prices dipped. This signals management's deep confidence in the company's long-term value and creates a tailwind for patient investors. Now here's where it gets interesting. Even with a solid beat, the stock dipped slightly post-earnings. Why? Because ASML's management admitted they can't yet confirm growth in 2026. For short-term traders, that was enough to hit the brakes. But for long-term investors, this may be an ideal opportunity. As CEO Christophe Fouquet noted, AI is still driving massive demand for both logic and memory, and the number of EUV layers used in chip production continues to grow. That means more machines, more upgrades, and more reliance on ASML. In short, ASML isn't just a semiconductor company, it's the foundation of every future-facing chip on the planet. And when short-term fear discounts a long-term moat, that's when smart investors pay attention. The third stock is Netflix Inc., ticker symbol NFLX, arguably the most resilient name in global entertainment and a masterclass in adapting through economic uncertainty. Despite macro headwinds including inflation jitters, higher for longer interest rates, and tariff-driven volatility, Netflix delivered a blockbuster Q2 2025 that stunned even the skeptics. The company posted $11.08 billion in revenue, growing nearly 16% year-over-year, and beat EPS expectations with $7.19 in earnings per share. But what really stood out? The fact that Netflix raised its full-year revenue guidance by $1 billion, not just because of foreign exchange tailwinds, but due to stronger-than-expected subscriber growth, rising ad revenue, and a monster content slate for the second half of 2025. And yet, here's the twist. The stock didn't rally. It dipped. Why? Because Netflix guided to a slight dip in Q4 margins due to content ramp-up and heavy marketing spend. But that's exactly what long-term investors should want. Netflix is doubling down when others are pulling back. The company's ad business is on track to double revenue this year, with its proprietary Netflix ad suite now fully rolled out globally. More advertisers are buying in at scale, thanks to Netflix's massive reach and high engagement. Add to that their expanding live sports and event lineup, from WWE and NFL games to blockbuster original films like Happy Gilmore 2 and Knives Out, and you're looking at a streaming titan that's no longer just competing with Hollywood, it's becoming Hollywood. In the words of Warren Buffett, be fearful when others are greedy and greedy when others are fearful. The market's fear-based selling on Q4 margin timing misses the bigger picture. Netflix is spending into strength, not weakness. And, with over 200 billion annual viewing hours and record Emmy nominations, Netflix's grip on global attention is unmatched. If the AI boom needs content, distribution, and real-time personalization to scale, Netflix is quietly building the rails for it. This dip, it might just be the best plot twist for long-term investors.